Right now, today, while you're watching this, there is a clock running on your bank account that almost nobody is paying attention to. Not April 15th, not your tax filing deadline, December 31st. And here's the part that should genuinely bother you. A huge chunk of the legal ways to reduce what you owe the government this year don't just have a deadline. They have a deadline that cannot be moved, cannot be extended, and cannot be fixed with an amended return once January hits. Miss it, and that money is gone for good. Permanently, no do-overs. Meanwhile, the average person sits there in March scrambling for receipts, completely unaware that the real opportunity to legally shrink their tax bill quietly expired months earlier, on a Tuesday, while they weren't even thinking about taxes at all. So today I'm walking you through the specific, completely legal moves you need to make before this year runs out, the ones that actually move the needle, not the small stuff. Some of these are things you can do in the next 10 minutes from your phone, others require a slightly bigger decision, but every single one of them is a real IRS-sanctioned way to keep more of your own money. And I'm going to tell you exactly which ones have a hard December 31st cutoff versus which ones give you a little breathing room into next spring. Because knowing the difference between those two categories is honestly half the battle here. Let's get into it. The first move, and genuinely the highest impact one for most working people, is maxing out your workplace retirement account, your 401k, your 403b, or your 457 if you have one. For this tax year, the contribution limit sits at $24,500, and if you're 50 or older, you get an additional catch-up contribution on top of that, bringing your total significantly higher. Every dollar you put into a traditional version of this account comes directly off your taxable income for the year, dollar for dollar. That's not a deduction with phase-outs and complicated rules attached. That's a straightforward reduction in the income the government actually taxes you on. Here's the part that catches people off guard every single year. Unlike an IRA, your 401k contributions have to come out of an actual paycheck dated before December 31st. There is no extension, there is no way to write a check in February and have it count for the prior year. If your last paycheck of the year already went out and you weren't contributing enough, that opportunity for this tax year is simply closed. So right now, today, log into your retirement account portal and check your year-to-date contributions against the annual limit. If you're behind and you have any remaining paychecks left this year, you can usually increase your contribution percentage significantly for those last few pay periods to close the gap before the window shuts. While you're in there, check one more thing that people leave on the table constantly: your employer match. If your company matches, say 100% of your contributions up to 4% of your salary, and you've only been contributing 2% all year, you have been quietly leaving free money unclaimed with every single paycheck. That match is not a bonus. It is compensation you already earned that simply requires you to opt in to receive it. Year-end is genuinely your last realistic chance to adjust your contribution rate and make sure you're capturing the entire match before the calendar resets and any unclaimed match for this year disappears for good. The second move is the health savings account, and if you have access to one through a high deductible health plan, this is arguably the single best tax advantaged account that exists in the entire tax code, and most people dramatically underuse it. Here's why it's so powerful. Money going in reduces your taxable income, just like a 401k. It grows completely tax-free while it sits invested, and when you eventually pull it out for qualified medical expenses at any point in your life, even decades from now, that withdrawal is also completely tax-free. Contributions in, growth, and withdrawals for medical costs are all untaxed. No other account in the entire system offers all three of those benefits stacked together. Unlike your 401k, your HSA contribution deadline is more forgiving. You actually have until the tax filing deadline the following April to fund it for this tax year, which gives you a bit more breathing room to figure out exactly how much you can afford to put in. But don't let that flexibility fool you into ignoring it until the last second, because the earlier that money goes in, the more time it has to grow tax-free before you ever touch it. There's a specific rule worth knowing here too, sometimes called the last month rule, which matters if you only recently switched onto a high deductible health plan partway through the year. Under certain conditions, you may still be allowed to contribute the full annual HSA limit for the year, even though you weren't covered by that qualifying plan for all 12 months, as long as you remain on a qualifying high deductible plan through the following year as well. If that applies to your situation, it's worth confirming with your plan administrator before year end, because getting this wrong can mean a portion of that contribution unexpectedly becomes taxable. The third move sits right alongside the HSA, the traditional and Roth IRA. And while these don't have that hard December cutoff we keep warning you about, they absolutely deserve a spot on this list because so many people simply forget they exist once they've got a workplace plan handling most of their retirement savings automatically. For this tax year, you can put in up to $7,500 or $8,500 if you're 50 or older. Whether a traditional IRA contribution is actually deductible depends on your income and whether you or a spouse are also covered by a retirement plan at work. So this is genuinely one of those spots where it pays to run the numbers rather than assume you automatically qualify for the full deduction. If your income is too high to deduct a traditional contribution directly or too high to contribute to a Roth at all, there's a well-established, completely legal workaround known informally as the backdoor Roth, where you contribute to a traditional IRA with no deduction and then convert it to a Roth shortly afterward. It sounds complicated the first time you hear it described, but it's a routine, sanctioned strategy, just one where a small mistake in the paperwork can create an unwanted tax bill, which is exactly the kind of situation where a few $100s of professional help genuinely pays for itself. The fourth move, and this one specifically has a hard December 31st cutoff that people constantly miss, is the Roth conversion. This is where you take money sitting in a traditional pre-tax retirement account and deliberately convert it into a Roth account, paying ordinary income tax on the converted amount now, in exchange for that money growing completely tax-free for the rest of its life, with tax-free withdrawals in retirement and no required minimum distributions hanging over your head later. This move makes the most sense in a year where your income is unusually lower than normal. Maybe you took time off, changed jobs, or retired early because converting fills up your lower tax brackets at a cheaper rate than you'd pay converting the same amount in a higher earning year. The critical thing to understand is that unlike a regular IRA contribution, a Roth conversion for this tax year absolutely must be completed by December 31st. There is no extension into the following spring for this one. Confuse this deadline with your IRA contribution deadline, which is far more flexible, and you will miss the window entirely with no way to go back and fix it. The fifth move is one specifically for anyone who's turned 73 or older, and it's not optional, it's mandatory, which is exactly why it belongs on this list. Required minimum distributions have to be pulled out of your traditional retirement accounts by December 31st every single year, with one narrow exception for the very first year you're required to take one, where you get until April 1st of the following year instead. Miss your required minimum distribution entirely or take out less than required, and the penalty is genuinely brutal, an excise tax on the shortfall that can run as high as 25%, although it drops significantly if you catch and correct the mistake quickly. If you're in this stage of life, or you're helping a parent manage their finances, this is not a step to accidentally forget about while you're focused on the more exciting tax moves on this list. The sixth move is tax loss harvesting, and this is one that catches a lot of investors off guard the first time they hear about it, because it sounds almost too convenient to be legal, but it absolutely is. If you're holding investments in a regular taxable brokerage account, not a retirement account, that have lost value since you bought them, you can sell those losing positions before year end and use the resulting loss to offset capital gains you've realized elsewhere in your portfolio this year. If your losses exceed your gains, you can use up to a certain amount of the excess to offset your ordinary income too, with anything beyond that carrying forward into future years. Here's the trap almost everyone falls into on this one though, something called the wash sale rule. If you sell an investment at a loss and then buy back that same investment, or something the IRS considers substantially identical to it, within 30 days before or after the sale, the IRS disallows your loss entirely. A common way around this, if you still want exposure to that general part of the market, is to sell the losing position and buy something similar but not identical, waiting out the 30-day window before considering buying back the original position if you still want it. And one more detail that trips people up, for this move to count for the current tax year, your trade actually has to settle by December 31st, which usually means you need to place the trade a couple business days before that, not literally on New Year's Eve at the last minute. The seventh move is bunching your deductions, and this one's specifically useful if you're someone who normally takes the standard deduction because your itemized deductions usually fall just short of clearing that bar. The idea here is that instead of spreading your charitable giving and other deductible expenses evenly across every year, you deliberately concentrate 2 years' worth of giving into a single calendar year, pushing your itemized total well above the standard deduction for that 1 year, and then reverting back to the standard deduction the following year when you don't itemize at all. Over a 2-year period, you end up deducting significantly more than you would have if you'd spread the same total giving evenly across both years and simply taken the standard deduction each time. A donor-advised fund is a particularly clean way to execute this strategy because you can contribute a larger lump sum into the fund this year, take your full deduction immediately for the entire amount, and then decide which specific charities actually receive the money over the following months or even years, completely separate from the timing of your tax deduction. The eighth move is specifically for anyone self-employed, running a small business, or earning significant freelance income, and it's worth taking seriously because the tax-advantaged options available to you are honestly more powerful than what a typical W-2 employee has access to. A solo 401k, available if you have no full-time employees other than yourself, your spouse, or certain family members, lets you contribute both as the employee and as the employer of your own business, which can allow for dramatically higher total contributions than a standard employee-only retirement account. If you want to set one of these up for this tax year and you're starting completely from scratch, don't wait until the final week of December to figure this out, because opening the account itself and understanding the contribution mechanics takes some lead time. Even though the contribution deadline for the employer portion can sometimes stretch into the following year, depending on your business structure. The ninth move is one that's specifically changing this year for higher earners, so pay attention if your income is on the higher end. If your wages from a specific employer exceeded a certain threshold in the prior year, currently set at $145,000, new rules now require that any age 50 plus catch-up contribution you make to your 401k has to go in as Roth, meaning after tax, rather than the traditional pre-tax catch-up contributions that used to be universally available. This doesn't reduce how much you're allowed to contribute overall, but it does change the immediate tax benefit of that catch-up portion specifically, so if this applies to you, it's worth double-checking with your plan provider exactly how your catch-up contributions are currently being classified before you assume you're getting a deduction you're actually not getting anymore. The 10th move is your flexible spending account if your employer offers one, and this is a genuine use it or lose it situation that a shocking number of people forget about until it's too late. Unlike an HSA, money sitting unused in most FSAs at year-end simply disappears, forfeited back to your employer, unless your specific plan offers a limited grace period or a small carryover allowance into the following year. Log into your FSA account balance right now and check what's sitting unused. If there's meaningful money left, look into scheduling an eye exam, stocking up on contact lenses, getting that dental work you've been putting off, or picking up FSA-eligible items before the year closes out, because letting that balance simply evaporate is one of the most avoidable losses on this entire list. The 11th and final move is simply this. Don't try to execute all of this completely alone if your financial situation has any real complexity to it. Multiple income sources, a business, significant investments, or a major life change this year, a CPA's fee to help you navigate something like a backdoor Roth conversion correctly, or to make sure a solo 401k is structured properly for your specific business, is genuinely often small compared to the tax savings or the costly mistakes it helps you avoid. Fixing an excess contribution or a botched conversion after the fact is far more expensive and stressful than getting it right the first time with a bit of professional guidance. Now let's quickly separate what's truly locked to December 31st from what actually has more flexibility, because mixing these two categories up is the single most common mistake people make this time of year. Your 401k salary deferrals are locked. They have to come from paychecks dated before the year ends, no exceptions. Roth conversions are locked to December 31st as well. Required minimum distributions are locked to December 31st, with that one narrow first-year exception. Tax loss harvesting trades need to settle by year end, which functionally means acting a few business days before December 31st, not on the day itself. On the more flexible side, your traditional and Roth IRA contributions, along with your HSA contributions, actually give you until the tax filing deadline the following spring. So, while it's smart to fund these as early as possible so your money starts growing tax-free sooner, missing December 31st on these two specifically does not close the door the way it does on the others. Here's the honest truth underneath everything on this list. None of these moves are secret loopholes. None of them require sketchy paperwork or hiding money somewhere the IRS can't see it. Every single one of them is written directly into the tax code on purpose, specifically to encourage behavior the government actually wants to encourage: saving for your own retirement, covering your own medical costs, supporting causes you care about, and building a small business. The people who benefit from these rules year after year aren't doing anything clever or aggressive. They're simply the people who checked their account balances in November instead of April, who knew which deadlines were truly fixed and which ones had flexibility, and who took 10 minutes to actually act on that information instead of letting the calendar quietly run out on them. So here's your actual homework. Right now, today, open your 401k portal and check your year-to-date contributions against this year's limit. Check your FSA balance if you have one. If your income was unusually low this year, look into whether a Roth conversion makes sense for your specific situation before that door closes for good. And if you're sitting on investment losses in a taxable account, start thinking now about whether tax loss harvesting fits your portfolio rather than waiting until the final week of the year when you'll be rushing trades that need time to properly settle. If this video just saved you from missing a deadline you didn't even know existed, drop a comment telling me which move on this list you're tackling first. I read every single one. And subscribe, because next week we're covering the tax mistakes people make in January that quietly cost them money for the entire following year. And trust me, most people have absolutely no idea they're even making them. Go check that 401k balance, and I'll see you in the next one.